So you go to chapter 10, investment appraisal. So when you talk about investment appraisal, basically we're talking about what you have put certain amount of money into something. Basically, you put a certain amount of money into capital goods. So before you can appraise that investment, and when you are even appraising that investment, it means you're thinking about the cost of that investment and the expected cash flow. That means, oh, if I'm going to spend so much, if I'm going to spend a certain amount of money, like I'm going to spend $5,000 on this investment, what will be the cash flow, the net cash flow on that particular investment? That is what we mean by investment appraisal. It means you are evaluating what your investment is. So you are evaluating what the return should be. That is what we mean by investment appraisal. Do you get investment appraisal here? Evaluating your investment, if it's going to be profitable or not profitable. Is it clear? So here they said, so let's go to the chapter now. That's the summary of what investment appraisal is. You are evaluating your investment, if it's going to be profitable or not. And for you to evaluate your investment, it means you are thinking about the cost of the investment via the amount of money you're going to make during the investment. Is it clear? So here, let's read. So investment appraisal. Here I wrote, investment itself, it refers to the purchase of capital goods. The purchase of capital goods. What are capital goods? Goods that are used to produce other goods. These are goods that can be used to produce other goods. Like machines. Yeah, like machines. They are investments. Because when you have machines, you will use them in the course of production. So whatever you use in the course of production is capital. Do you understand what capital goods are? So do you understand what capital goods are? So we said investment is what? The purchase of capital goods. And when we talk about capital goods, we're talking about goods that can be used to produce other goods, like machines. So investment can also be an expenditure that will yield return in the future. So whatever you have spent on now, you've spent on it because you feel it's going to give back a return in the future. That is also an investment. So not only when you invest or when you purchase equipment or machines that you are investing, whatever you spend on, because you feel in the future you're going to make returns on them, it's going to be profitable in the future, then it is also investment. Do you understand? Education is also an investment because after you graduated from the university, you start working, then that means there's going to be a return on your investment. Do you understand? So whatever expenditure you have, expenditure means spending, whatever expenditure you have that makes you to think that, oh, in the future, there's going to be a return on it. It is an investment. I think it's clear. Yeah. So investment appraisal, here I wrote, it describes how a business might objectively evaluate an investment project to determine whether or not it is likely to be profitable. So when you're appraising, when you're making an appraisal, it basically means that you are evaluating the profitability of that investment. Oh, if I'm going to spend 10,000 on these projects, is it going to yield? Is it going to return? Is the 10,000 going to be returned? Will this business be able to return the 10,000? That is what we mean by investment appraisal. So there are different ways or methods that you can invest, that you can evaluate your investment. That means there are different methods of investment appraisal. So it depends on your business and how the situation of your business. That will determine the kind of method you want to use to evaluate your investment. Do you get the point here? So we've talked about investment itself, which means you're purchasing a capital goods. And when you are purchasing a capital good, it means you are purchasing a product or a good that can be used to produce other goods. We talked about investment as also an expenditure that will yield a future return. So whatever you have spent on that you are expecting a return from in the future, it is an investment. Is it clear? Yes. Now we go to investment appraisal itself. I said investment appraisal means you are evaluating if your expenditure will yield returns in the future. That means if your expenditure will be profitable or not. So when you're thinking about the profitability of your expenditure, it means you are appraising it. Then they said during investment appraisal, businesses will compare the capital cost of the project and the net cash flow. So there are two things you have to put into consideration when you are evaluating your investment or when you are appraising your investment. You think about the capital cost, the amount of money you're going to spend to make that project done, the amount of money you're going to spend to ensure that the project is done, and also the net cash flow. And when you talk about the net cash flow, we're talking about your cash inflow minus your cash outflows, the amount of money that's you generate, the revenue you're going to generate, and the expenses that you will incur during that project. So the cost is different. The capital cost is the amount of money you spend to ensure that the project is done. It's different from the expenses. The overheads, that means the expenses you make during the course of that business transaction, during the course of the business operation. That is what we mean by your cash outflows. It's not the same as your cost. Your cost is at the beginning. Your cost makes sure that the production is made available. Your cost is what you incur when you purchase that equipment or that machine. In the cost of using that machine, maybe you need to pay workers to operate the machines. Maybe you need to service the machine. All these ones are your cash outflow. Do you see the difference between the capital cost and the cash outflows? Then the cash inflow is the amount of money you make in the course of your operation. You get the difference here now. So when you are doing investment appraisal, what are you trying to do? You are trying to compare the capital cost with the net cash flow. And we're talking about the net cash flow. We're talking about the cash inflows minus your cash outflows. The amount of the revenue you generated minus the expenditures in the course of operation. Do you have any question about that? Okay. So one of the methods so we have some table here, which is talking about comparing different projects here. So one of the methods we can use when we are evaluating our investment is payback. You have the simple payback there. Can you see it? So when we talk about payback refers to the time at which the amount of the capital cost will be returned. That means, you're spending 10,000 now. How long will it take to get the 10,000 back into the business? That is the payback period. Do you understand what payback is here? So here I wrote payback. This refers to the amount of time it takes for a project to recover. So we have invested 10,000 now. How long is it going to take to get back the 10,000? It's going to be 6 months. It's going to be 10 years. It's going to be 5 years. So after that years, whatever you make becomes your profit. But when are you going to get that amount you've spent on that project, on that venture? That is what we mean by payback period. Do you understand what payback is here? Do you understand what payback is here, please? So we'll go to calculating the payback period. So it is calculated by dividing the cost of the investment by the annual cash flow until the cumulative cash flow is positive. So you have invested. So because you have invested a certain amount of money into that project or into that business, it is on negative. So you continue to calculate until it becomes a positive figure. You've invested 10,000. That means a negative now. So your business is on the negative side of 10,000 until you have a 10,000 that will nullify that negative 10,000. That is what went by the cash flow until it becomes cumulative cash flow is positive. So that means the amount of money you're going to make will have to nullify that 10,000 you've invested or in the use of purchasing that equipment. So when that is done, then you start calculating your return on investment. There's return on investment, but there's a payback period. A payback period will calculate the number of time, the amount, the duration at which you'll be able to make the amount of money you've spent in purchasing that equipment. I think you understand the payback period again now. Okay. So for the payback period, we have different methods of calculating the payback period. We have the averaging method. When we talk about the averaging method, it means you're calculating the initial investment divided by the yearly cash flow, the amount of money you've spent in buying. That means your initial investment is the amount you purchase that equipment. Let's say you purchase the machine. You purchase it for 10,000. But you are expecting that machine to make 15,000 during the year. Do you understand? Do you get my point here? The amount, the initial investment, the amount of money you spend, your capital cost divided by your yearly cash inflow, your cash flow. That is how you calculate your payback period. Do you understand? So, this year we're going to make 1,000. So that means your yearly cash flow is 1,000, but your investment, your initial investment is 10,000. So it means it's going to take 10 years to get back. The payback period will be 10 years. That is what we mean by averaging method. Yeah. Initial investment divided by the yearly flows, yearly cash flow. Okay. Is it clear? Okay, so we go down. Then we have a project here. For this project, which page? The next page. That's page 72 now. Go down to page 72. We have the work example here. So the investment is 70,000. That is why it is in negative. You see the bracket here means negative. That is the initial investment. So this is a project which has different net cash flow. It has the cumulative cash flow. So we have for project A, we have the net cash flow and the cumulative cash flow. We have project B, we have project C. Here, it means this manager is trying to compare different project A, project B, project C to see which one is visible, which one is profitable. That is when you have an analysis like this. You are making this is an investment appraisal. Do you get what I'm talking about here? This is an investment appraisal. And why are you doing this investment appraisal? You are doing this investment appraisal to know when you'll be able to return the payback period for that investment, and if the business investment is going to be profitable. That's why you have an appraiser. You are evaluating. Are you with me, please?
Yes, sir.
Okay. So, here they said in this example, project C will be chosen because it has the shortest payback period, which is 2 years. So when you compare project A, project B, project C, the one with the least payback period is project C. It's going to take 2 years and 6 months to make the 70,000, which has been invested. The project B is going to take 3 years and 6 months to make the 70,000 if invested. And project A is going to take 4 years and 4 months to make the 70,000 if invested on. So how do you calculate the payback period? For this analysis here, 70,000 was used. 70,000 was the investment. And they said about project C. So for project C, we have the 70,000, which was invested. And within the month, the cumulative cash flow will be, the first year, you're going to make 30,000. The second year, 30,000, which is 60,000. But the invested amount, the initial capital invested is 70,000. But in the next 2 years, you're going to make 60,000. So that means your payback period will consist of 2 years. But it's not going to end there because certain amount, 10,000 is left. So where are you going to make the 10,000? You're going to make the 10,000 in the third year. And in the third year, you are expecting to make an inflow of 20,000. Are you seeing it, please, in the project? So in the third year, you're going to make investment of 20,000. You're going to make an inflow of 20,000. So that means you'll be able to pay the 10,000 in the third year. So that means in the third year, the payback period will be within the third year. So that means 2 years and some few months. So how will you be able to calculate the few months? To calculate the few months, there's a formula for that. You say I wrote it already. Yeah, for the few months. Here they said the amount required divided by the net cash flow in a year, multiplied by the amount needed to complete the required amount, divided by the amount the required amount is deducted from. Listen, please. You need to calculate in 2 years, we won't be able to meet up with the investment because the investment is 70,000. But in 2 years, we're going to make 60,000. So it means in the third year, which has 20,000 inflow, we'll be able to pay the 10,000 there. Do you understand? So that means from 20,000, you 20,000 minus 10. 20 minus 10. Okay, so to calculate your payback period here, the amount required, we're talking about the investment, which is 70,000. No, the required amount is 37,000. Wait, let's say to pay for an investment of 70,000. Okay, you understand? To pay for the investment of 70,000. How do we go about it? To pay for the investment of 70,000, that's the investment which is 70,000. We are able to pay 60,000 in 2 years. So that means we have 10,000 to pay back. So how do we pay the 10,000 back? We pay it from the third year. So for the third year, the amount required is 70,000. The net cash flow within the net cash flow is how much? The net cash flow here for the third year, we have it. The net cash flow is 40,000. Are you seeing it, please? The expected net cash flow is 40,000. So the amount required we need is 70,000. The expected cash flow for each year is 40,000. So it means 70,000 divided by 40,000 multiplied by the amount. What's the amount? The amount that is left that we need to pay for is 10,000, which we're going to get from the second year, the third year. So it means 70,000 divided by 40,000 multiplied by the amount needed to complete the required amount, which is 10,000, which is only from the third year. So it will be 10,000. So here we're going to have amount required, which is 70,000, divided by the net cash flow in a year, which is 40,000 for project C. I think you can see it here.
Yes.
40,000 for project C, multiplied by the 10,000, which we are able to get in the third year, divided by the inflow of the third year. So that gives us, then you multiply it by 12 for the whole month, because each month, this is 12 months. Because it's, you know why it's 12 months? Because in a year, you're going to make 20,000, but we don't need the whole 20,000. We need part of the 20,000, which is 10,000. And how do we get the 10,000? It means 10,000 divided by 20,000 multiplied by 12. You get it? So that's how they got the 6 months. Is it clear, please? Yes, so the payback period for project C is 2 years and 6 months, which means it's the shortest possible period at which you can pay back the investment. Do we understand, please? Mm-hmm. So during this investment appraisal, a manager would have done this investment appraisal. He would have evaluated project A, evaluated project B, and evaluated project C. So based on what the payback period is, because we are using the payback period here, some businesses might not use investment appraisal of payback. They might not evaluate using the payback period. They might use accounting return. So there are different methods, like I told you earlier. There are different methods that you can use for your payback period. But if you are using the payback period, it means you are checking out the possible short period time, the possible shortest period that you can pay back that investment. So using the payback period, based on what we have here, project A has a longer period of time to pay back. Project B has the shortest, shorter one, but project C has the shortest. So the manager will go with project C because the manager is using the payback period. Do you have any question about it? No, okay. So what are the advantages of using the payback method? So when you're using the payback method, the advantages are the following. One, it is simple to use. It is easy. For payback period, what do you have to do? You check the initial investment, you divide it with the yearly cash flow. So it's easy. So you don't have to think deep before you appraise the project. You have project 1, project 2, project 3. So which one is going to give me back the return on that investment? It's project A. So because you know already, by dividing, you use your averaging method, initial investment divided by the yearly cash flow, you get the payback period. So it is simple.
Yes.
That's the first advantage. The second one, it is useful. It is useful, especially when technology changes rapidly. So most of these days, you have equipment of this year. Next year, there's an update on that equipment. Yes or no? Yes. So because there's every now and then there's updates about equipment, it means that we have to be investing on different equipment to meet up with the competitive environment we have, to meet up with the demand of our customers. So as a result of that, you think ahead of using payback period because you think about what you gain. When are you going to be able to pay back this amount of money? So because technology changes rapidly, it means you have to think about investment that will yield a quick return. You need to think about a method that will yield a quick return. And the best method is the payback period. Oh, there's a new equipment in town. Oh, it's 10,000. How long are we going to be able to meet up with this 10,000? The best method to use is what? The payback period. Because it's going to tell you immediately if it's doable, if it is profitable to invest on it or not. Is it clear? Yes, sir. The third one. This method is suitable for firms with cash flow problems because the projects chosen will pay back investment more quickly than others. Like the average rate of return, like the accounting average rate of return, it takes time. You need to think about the profit you make per annum, per year, and the capital you are investing on it. But for the payback period, if you're having a problem about cash flow, you'll be able to know that, oh, if we are investing in this project, the cash will come back in the next 2 years. A business that is having a problem with cash flow would not want to go with a project that is going to take ever before the investment will return. Do you get what we're talking about here? What we're saying is businesses that have problems about cash flow, they would prefer to use payback period because it's going to assure them the shortest possible time in which their investment will return. Because when the investment does not return, you won't be able to use the cash flow, you won't be able to use the cash for other processing or for other operations. So businesses that have problems with cash flow might want to use payback period because using payback period will tell you the shortest possible time in which the initial investment will come back. Do you have any question about it? No. So that is all about payback period in investment appraisal. We have different methods to use when we are evaluating our investment, which is the same as investment appraisal. One of the methods that we can use is the payback period. And when we talk about payback period, we're talking about the duration at which the amount of money spent, the capital cost, will be able to be returned back into the business. And when you're talking about investment appraisal, I told you, it means that you are evaluating the profitability of your venture. You are evaluating the profitability of your investment. I think investment appraisal is clear using payback period method. Any questions about it? No. Okay.